morning. This is Jim Harvey, and this podcast is entitled Recent Market Volatility and You. On January 3rd of 2020, stocks hit a new record high, potentially signaling to investors that gains in 2021 was just going to continue unabated in 2022. However, the next day, on the 4th, things reversed, and it's been a couple of rough weeks for the markets ever since. To wit, the S&P from January 3rd to the 24th was down 8, the NASDAQ down 12.48, the Dow Jones Industrial Average down 5.99, the Russell 1000 Growth, which is the large cap growth index, was down 12.29, the Russell 1000 Value was down 3.87, the Russell Mid Cap was down 8.08, and the Russell 2000, the small cap index, is down 10.5. The Dow Jones and Industrial Average and the S&P are on pace for their worst month since March of 2020, which is when the market panicked amid the turmoil created by the COVID pandemic. It seems like old news now, but back then the market dropped, over 30% in a month. The NASDAQ, meanwhile, is headed for the biggest one-month loss since 2008. As a result of the recent sell-off, we've seen some indices enter correction territory, which basically means in industry parlance, it's down at least 10% or more from the previous highs. While market volatility is unsettling, it's not unusual historically. On average, since 1980, markets have experienced 4-5% pullbacks each year. Similarly, since 1980, the average year in the S&P index sees a 14% peak to trough correction every year. Thus, it's important to remember that corrections are a normal part of investing, and there's still plenty of reasons why stocks can push higher from here. For example, strong consumer and resilient corporate earnings. Therefore, we would stress that this is not a time to panic, and we never panic, but a time to be confident in your long-term plan and potentially take advantage of volatility by rebalancing your portfolio to parts of the market that have been hit the hardest. Or put another way, what's on sale? And when you're looking at your portfolio, go, all right, well, I have this stock and maybe it's at a loss. Is there another stock in the same industry that I could buy? Take the loss and then recover when the market recovers. As recoveries from corrections, meaning down 10%, have taken 4 months on average, staying invested in the market could be additive to your portfolios, leaving investors better off in the long run. I mean, we all have heard, and we've said this countless times, that timing the market is either virtually impossible or very difficult at best. So lastly, I just want you guys to know that we do not think we're entering a bear market. And the reason is that the sell-off wasn't triggered by poor economic fundamentals, but rather a compounding of individual events that the market view as unfavorable. What are those events? What sparked these sell-offs? Well, we're in the thick of fourth quarter earnings seasons with some 200 S&P companies on deck to report this week and next. Investors have uncertainty about earnings growth. Any lackluster earnings reports coupled with inflation running hot could hurt profit margins. Geopolitics is front and center with nearly daily headlines suggesting escalating danger of armed conflict in the Ukraine. The prospect of a Fed that is focused on fighting inflation by raising interest rates and reducing the size of its balance sheet over the next several quarters has been tough for the market to digest. And then, there are times, and we joke about this, that, in a bull market, bad news is good news, and in a bear market, in a bull market, bad news is good news, and good news is good news. In a bear market, good news is bad news, and bad news is bad news. And that just has to do with human behavior and our tendency to sort of see what's happening right this minute, but not really step back and go, okay, is this something to worry about? The other thing that I think you have to pay attention to, and this is really important in terms of how things are allocated, is that the high concentration of the top 5 stocks in some of the indices has exaggerated the sell-off. The point of the Fed hiking rates is that one deserves the most attention, as we believe it is the cause of the majority of the market volatility. Stocks have felt pain for this for 2 reasons. First, due to higher rates, The rate at which investors discount future cash flows is higher, which brings down the current valuation of companies. Secondly, higher rates usually mean slower economic and earnings growth in the future, which can hurt stock prices now. Higher rates are a particular concern to the makeup of the S&P because the S&P is a market cap weighted index. So it is dominated by the largest names in the market, which are the big tech companies, or said another way, large cap growth stocks right now. Large caps have enjoyed almost 2 years of price earnings multiple expansion, which means that they're growing. And much of it has been deserved because of accelerated adoption of their platforms, exceptional earnings growth, and most importantly, low interest rates. Let me give you some perspective on this. Over the past 2 years, the top 5 names in the index, Apple, Amazon, Microsoft, NVIDIA, and Facebook, have had significant impact on the S&P index's overall return. In 2020, those top 5 names returned 71% on average. And that 71% return on those 5 stocks was responsible for about 62% of the index's total return. I mean, think about that. 5 companies responsible for 62% of the total return of an index that has 495 other names on it. In 2021, those top 5s returned 65% on average and was responsible for 31% of the index's total return. Right now, the top 5 names constitute close to 20% of the S&P index in market value, and the technology sector makes up about 30% of the index, more than twice the size of the next largest sector. Similarly, the NASDAQ has a 45% exposure to the technology sector. Therefore, the success of the technology sector is closely tied to the success of the broader market. Just as those stocks can support markets on the way up, we have seen, as we have seen this year, that can also exaggerate a sell-off in the way down. So what's our view? First of all, this is a normal market sell-off. We have the rule of 55, 65, and 75 that we like to share with clients. And what that rule says is that the market is up 55% of all trading days, 65% of all trading months, and 75% of all trading years. That is the case despite the fact that on a regular basis, there are market sell-offs every year. So this is a normal market sell-off, especially amidst the removal of unprecedented monetary and fiscal stimulus to handle the COVID crisis and historically muted market volatility coming into this year. Investors were spoiled in 2021. The S&P index went 227 days without a 5% drop, the 7th longest such streak on record. It's extremely rare for the market to enjoy a period of relative calmness, such as lengthy stretches without a 5% pullback or better have occurred on only 8 occasions in the history of the S&P 500 index. Similarly, stocks have not had a 10% correction since March of 2020, and the S&P 500 has averaged exactly 110% correction per year since 1950. So although the fear of the Fed raising rates faster than people expect and current economic data is solid and earnings growth, while lower, will remain resilient. So the Fed rate hikes by themselves do not mean the bull market is approaching an end. In fact, a year after the first hike and the previous 8 hike cycles saw the S&P 500 higher a year later every single time. So while some of those returns were muted, by no means were they considered bear market events for investors. In closing, 2021 marked only the 10th time the S&P has generated 3 straight years of positive double-digit returns in the last 90 years. The S&P was up 31.2% in 2009, 18.4% in 2020, and 28.71% in 2021. Due to increased market volatility, we may not get a 4th year of double-digit returns for the S&P. However, we believe equities will continue to push modestly higher, returning somewhere between 8 and 10%. So what does this mean for you? Well, first of all, you should be looking at your portfolio. Obviously, if stocks are selling off in the large cap growth sector, where's the money going? Well, we've already seen a rotation to large cap value. And large cap value is attractive because it generally has a pretty good dividend yield in the 2 to 3% range, and pretty modest appreciation potential. But it's also going to be affected by flows of funds. And so if people are worried about a market correction and the stock market starts selling off, what are they going to sell first? They're going to sell their stocks at the highest profit, which means those top 5 stocks in the S&P, and that means large cap growth. I also think there are other areas to look at, and you should either give us a call or talk to your advisor about some of those areas. One would be international, developed markets, which have really just not participated in all in a major way when compared to the US over the last 12 years. Emerging markets are another area which you have to be careful for. You should check to see if you've got good exposure to commodities, because if inflation's going up, commodities and real estate can be a good place to take a look. This is a time not to stick your head in the sand and just curl into a ball, but to look the opportunities in the eye, look at your portfolio, and then work with your advisor, or if you're doing it on your own, think about it on your own, and make some moves that make some sense. But timing the market is probably not the best approach. Well, this is Jim Harvey, president of Opus 111 Group, and I hope you've enjoyed this. Go to our website on www.opus111group.com and go to our Learn page, and you'll see a lot of other audio and video podcasts about our perspectives on the market and how you might best respond. Have a good day.